Investment mistakes can cost you money, and that's why you must try to avoid them. Successful investing is not just about selecting the right stocks. One must also avoid simple mistakes that might undo all the previous hard work. During the stock market collapse in early 2020, many investors witnessed what impatience can lead to as they started liquidating their portfolios. The markets bounced back and then broke previous highs quickly after the collapse, rewarding the investors who had the patience and planned well. So in this video, we are going to discuss top 10 mistakes to avoid when investing in the stock market. So the video is going to be amazing, so make sure to stick till the end. Now before we get into this video, make sure to hit that subscribe button and leave a comment below saying I subscribed. I will try my best to reply to as many comments as possible. There are 3 barriers that prevent an individual from investing in the stock market: fear, inequitable access, and insufficient funds. Unfortunately, many courses fail to address these barriers, particularly in schools that host students from underserved communities. Number 10. Lack of investment goals. One of the most common mistakes while investing in international stock markets is a lack of proper investment goals. You need to articulate your investment objective and deploy the best tools to achieve these objectives. The goal can be anything: saving up for your child's foreign education, creating a retirement fund, or just hedging your USD expenses. The important thing is to plan appropriately. Despite the rise of commission-free trading platforms, many are still unsure what it means to invest or may feel that they still don't have enough money to invest. That's why exposure is critical, and it's imperative that our public education system equips students with an understanding of basic financial principles and provides exposure to the world of investing. Number 9. Trying to time the market. Another common mistake in stock trading is trying to time the market. It's challenging to time the market, and even seasoned investors often fail to do it right. A famous study, Determinants of Portfolio Performance, on American pension fund returns showed that around 94% of the portfolio's returns result from correct asset allocation, not from market timing or individual stock selection. Number 8. Don't just pick stocks. Asset allocation is equally important. Several research studies show that asset allocation is the key to a successful investment portfolio. However, investors make a common mistake focusing on picking individual stocks instead of doing proper asset allocation. So instead of choosing the next hot stock, you should aim to correct the asset allocation first. Number 7. Thinking historical returns as measure for future performance. One of the most common mistakes while investing is relying on historical returns. Past results are often not accurate indicators of future performance. For long-term investors, predicting the market is not practical, and they should not attempt to do so either. The goal should be to build a portfolio with a long-term investment horizon, with historical performance only serving as risk indicators for an asset. Number 6. Lack of patience. Successful long-term investing is 1% action and 99% patience. However, many investors lack that patience and end up continually tinkering with their portfolios. To have a disciplined approach, you must look beyond the short-term volatilities and concerns and concentrate on the market's long-term growth potential. Market fluctuations are bound to happen. However, it's crucial to stay the course and stay invested if feasible. Number 5. Waiting to get even. Waiting to get even is another common mistake you must avoid while investing globally. Getting even means you are waiting to trade a losing stock until it returns to its initial price. Behavioral finance labels it a cognitive error, meaning that you are losing in 2 ways by failing to accept a loss. First is by not selling the dropping stock, which may slide even further and become worthless. Secondly, you are losing out on an opportunity to use that investment money on something better. Ask yourself a question: would I buy that stock today? And if the answer is no, then you should not continue holding it. Number 4. Forgetting to match investment style with personal objectives. It helps to remember that one size doesn't fit all. It would be unreasonable to pursue an investment strategy that doesn't suit your investment goals. The idea is to find a method that can honor your risk tolerance, objectives, and resources. Number 3. Relying on emotions. There are several biases at play when you make an investment decision. Relying on emotions in a volatile market is another common investment mistake. If you cannot wait to buy or sell a stock for a few days, you are probably making an emotional decision. You should not rush your investment decisions because you felt like it. The fewer feelings you involve in the market, the better. Number 2. Falling in love with a stock. Often, when you see a chosen stock doing well, you may end up investing further in it. Nothing wrong with that, but be careful not to neglect other asset classes, opportunities, and your investment objectives. Number 1. Over-diversify. Diversification is a great risk management tool when used properly. It offers value when assets have different risk profiles and have low correlation. For instance, while diversifying a U.S. stock portfolio, you can think of adding unrelated assets like equity, bond funds, commodity ETFs, and gold stocks, etc. However, over-diversifying can be suboptimal. For instance, adding U.S. equity ETFs to a diversified U.S. stock portfolio may not make sense. 3 strategies to help reduce investment risk. How can you avoid making these common investing mistakes? Consider these investment strategies, which can help you reduce the risks associated with investing and potentially earn more consistent returns over time. Asset allocation, portfolio diversification, dollar cost averaging. Asset allocation. Appropriate asset allocation refers to the way you weight the investments in your portfolio to try to meet a specific objective. It's the act of investing in different asset classes, such as stocks, bonds, alternative investments, cash. For example, if your goal is to pursue growth and you're willing to take on market risk to reach that goal, you may decide to place as much as 80% of your assets in stocks and as little as 20% in bonds. Before you decide how you'll divide the asset classes in your portfolio, make sure you know your investment time frame and the possible risks and rewards of each asset class. Different asset classes offer varying levels of potential return and market risk. For example, unlike stocks and corporate bonds, government T-bills offer guaranteed principal and interest, although money market funds that invest in them do not. As with any security, past performance doesn't necessarily indicate future results, and asset allocation does not guarantee a profit. Portfolio diversification. Asset allocation and portfolio diversification go hand in hand. Portfolio diversification is the process of selecting a variety of investments within each asset class to help minimize investment risk. Diversification across asset classes may also help lessen the impact of major market swings on your portfolio. How portfolio diversification can reduce investment risk. If you were to invest in the stock of just one company, you'd be taking on greater risk by relying solely on the performance of that company to grow your investment. This is known as single security risk, the risk that your investment will fluctuate widely in value with the price of one holding. But if you instead buy stocks in 15 or 20 companies in several different industries, you can reduce the potential for a substantial loss. If the return on one investment is falling, the return on another may be rising, which may help offset the poor performer. Keep in mind, this doesn't eliminate risk, and there is no guarantee against investment loss. Dollar cost averaging. Dollar cost averaging is a disciplined investment strategy that can help smooth out the effects of market fluctuations in your portfolio. With this approach, you apply a specific dollar amount toward the purchase of stocks, bonds, and or mutual funds on a regular basis. As a result, you purchase more shares when prices are low and fewer shares when prices are high. Over time, the average cost of your shares will usually be lower than the average price of those shares. And because this strategy is systematic, it can help you avoid making emotional investment decisions, thus minimizing investment risk. Let us know your opinion in the comment section below. This was all for today. Hope you liked the video. Subscribe to our channel and stay tuned for more interesting videos. Stay safe, and we will be back soon with another video.